Good afternoon. In recent weeks, some of the risks to the inflation outlook have dissipated somewhat. The rand appreciated following the ANC elective conference and after Eskom was granted a lower than expected tariff increase. While S&P Global Ratings downgraded South Africa's long-term local currency, sovereign currency credit rating to sub-investment grade, Moody's Investor Services placed the country ratings on review for a downgrade. A further downgrade, therefore, remains a risk and will depend on the government's response to the deteriorating fiscal position and commitment to credible growth-enhancing policies. Against this more positive backdrop, the inflation forecast has improved despite continued increases in international oil prices. Near-term inflation is expected to remain close to the midpoint of the target range. At the same time, domestic growth outcomes have surprised on the upside, in large part due to the recovery in the agricultural sector. While there have been moderate upward revisions to the growth forecast, the outlook remains challenging. The year-on-year inflation rate, as measured by the Consumer Price Index, for all urban areas measured 4.6% in November, down from 4.8% previously. Lower food and fuel price inflation contributed to this decline. Good price inflation moderated to 3.7% from 4.1% previously, while services price inflation was unchanged at 5.5%. The bank's measure of core inflation, which excludes food, fuel, and electricity, measured 4.4% in October compared with 4.5% previously. Year-on-year producer price inflation for final manufactured goods measured 5.1% in November, up from 5.0% in October. Food price inflation moderated further to 0.9% due to strong base effects from lower agricultural prices. Meat price inflation, however, remains elevated as the adverse effects of the recent drought continue to be felt. The inflation forecast generated by the bank's quarterly projection model, the QPM, shows some improvement since November. The average forecast for 2017 is unchanged at 5.3%, but has been revised downward for 2018 and 2019 to 4.9% and 5.4% from 5.2% and 5.5% previously. Inflation is expected to average 5.5% in the final quarter of 2019. The lower turning point of the forecast is still expected in the first quarter of 2018, but has been revised down from 4.7% to 4.4%. The main drivers of the more favorable forecast were the stronger exchange rate and lower electricity price assumption, following the 5.23% electricity tariff increase granted to Eskom by NERSA. This adjustment takes effect from July, when a 6.0% increase is assumed in the CPI compared with 8.0% previously. The assumption for mid-2017 remains unchanged at 8.0%. These effects are countered to some extent by upward adjustments to the international oil price assumptions, as well as by the impact of the sugar tax on food prices. This tax is expected to increase food price inflation and headline inflation by 0.6 and 0.1 percentage points respectively in the year following its expected implementation in April. Food price inflation is now expected to average 5.2% and 6% in 2018 and 2019, up from 4.5% and 5.9% previously. The core inflation forecast is unchanged at 4.8% for 2017, but has been adjusted down to 4.6% and 5.1% in 2018 and 2019 from 5.1% and 5.3% respectively. Whereas previously a lower turning point of 4.6% was expected in the final 2 quarters of 2017, a low of 4.4% is now expected in the first quarter of 2018. The improved forecast for core inflation is driven mainly by the stronger exchange rate, which is expected to impact favorably on core goods inflation. Higher wage pressures, by contrast, are expected to keep core services inflation more or less unchanged. The closing output gap also reduces the degree of downside pressure on inflation. Average inflation expectations for 2018, as reflected in the survey conducted by the Bureau for Economic Research in the 4th quarter of 2017, declined marginally from 5.8% to 5.7%, but remain close to the upper end of the target range. Average expectations for 2019 were unchanged at 5.9%, as were average 5-year inflation expectations at 5.6%. These moderate moves marks larger adjustments compared with the 3rd quarter survey, with business people revising expectations higher over the 2 years, offsetting the downward adjustments by trade union officials. The expectations of market analysts, which are reflected in the Reuters Econometer survey conducted in January, also show a slight improvement since November. The median forecasts for 2018 and 2019 have declined by 0.1 percentage points to 5.1% and 5.4%, whilst the forecast for 2020 is 5.5%. Inflation expectations implicit in the inflation-linked bond yields have declined, with the 5-year break-even in inflation rates declining to 5.4%. The global growth outlook remains positive and remains synchronized, although uneven across regions. However, some moderation in growth is generally expected in 2019. Growth in the US is expected to be given a boost by the proposed tax reforms, but the extent of this is still unclear. The euro area recovery also appears to be sustained, with a persistent decline in the unemployment rate amid a broad-based firming of fixed capital formation. The recent positive momentum in Japanese growth is also expected to continue. These favorable conditions are expected to have a positive spillover effect on emerging markets in general, with upward growth revisions in most regions, although less so for Latin America and Africa. Commodity exporters are also expected to benefit by the recovery in commodity prices. Consensus forecasts suggest that growth in China will be sustained at current levels, despite continued financial stability risks. Global inflation trends, by contrast, remain subdued, although there are indications of emerging upside pressures, driven in part by higher energy prices. Core inflation pressures are also becoming evident in the US in particular, and are expected to intensify gradually should strong growth and labor market tightness persist. Monetary policies in the advanced economies, particularly in the US and in the UK, are expected to maintain a tightening bias, whilst the pace of withdrawal of monetary accommodation in the euro area and Japan is expected to be slow. These trends should help sustain capital flows to emerging markets. The rand exchange rate responded strongly to the outcome of the ANC elective conference, and since then has traded in a range of between 12 rands 25 and 12 rands 50 against the US dollar. This is a sharp contrast to the recent low of 14 rands 47 a month earlier. Since the previous meeting of the MPC, the rand has appreciated by 13.1% against the US dollar, by 9.6% against the euro, and by 10.6% on a trade-weighted basis. In the near term, the rand is expected to remain sensitive to sentiment generated by political developments. The favorable outlook for capital flows to emerging markets, as well as the positive trade account balances, are expected to be supportive of the rand. The latter is a reflection of the favorable terms of trade and import compression from lower growth. However, the lingering prospect of a credit ratings downgrade to sub-investment grade by Moody's continues to weigh on the longer-term outlook for the rand. Such an event would trigger the exclusion of South African government bonds from the World Government Bond Index and is likely to precipitate significant capital outflows. The extent of the impact on the exchange rate remains uncertain. Domestic growth prospects appear to be showing some signs of improvement, although of a low base. This follows encouraging growth rates in the second and third quarters of this year, driven to a significant degree by the exceptionally strong recovery in the agricultural sector. The bank has revised its forecast for GDP growth up from 0.7% to 0.9% for 2017, while forecasts for 2018 and 2019 have been adjusted to 1.4% and 1.6%, up from 1.2% and 1.5% previously. This more favorable outlook is consistent with the further increase in the bank's composite leading business cycle indicator of economic activity in October. The outlook is also likely to be impacted positively should recent political developments lead to a sustained boost in business and consumer confidence. High-frequency data suggests that fourth quarter growth is likely to be slower than the previous quarter, but still positive. On a month-to-month basis, mining output increased in October, but declined in November, while manufacturing output increased in both these months. However, the decline in the ABSA PMI to 44.9 index points in December is indicative of the continued challenges faced by the sector. More positively, the sub-index measuring expected business conditions in 6 months' time improved markedly. Despite the continued weakness in the RMB BER Business Confidence Index, growth in real gross fixed capital formation improved in the third quarter, following a contraction in the previous quarter. All three sectors recorded growth rates in excess of 4%. The recovery was most pronounced in the private sector. The durability of this improvement will be highly dependent on the extent to which recent political developments impact on confidence and lead to greater policy certainty and credibility. This process could take some time. At this stage, the forecast is for minimal growth in gross fixed capital formation this year, with a slight improvement in 2019. A prolonged recovery in fixed capital formation is needed to make inroads into the official unemployment rate of 27.7%. The quarterly employment statistics survey of SABC shows that during the third quarter of 2017, formal non-agricultural employment in both the public and private sectors declined further. Adjusted for election-related employment by the IEC, private sector employment creation more or less offset public sector losses in the 4 quarters to the 3rd quarter of 2017. Growth in real final consumption expenditure by households decelerated to an annualized rate of 2.6% in the 3rd quarter, but was characterized by a sharp increase of 19.9% in expenditure on durable goods, mainly motor vehicles. Some moderation in consumption expenditure growth is expected in the 4th quarter following weaker motor vehicle sales. However, the strong Black Friday effect evident in the November retail trade sales may moderate the extent to this slowdown. Despite being relatively constrained, the outlook for household consumption expenditure has improved, with annual average real growth rates of around 1.3% expected over the forecast period. This category is expected to be the main driver of GDP growth in the short to medium term. Although consumers are likely to be adversely affected by possible further tax increases, expenditure is expected to be underpinned by lower inflation and positive real wage increases. Growth in bank credit extension to households remains weak, but has trended slightly higher in recent months. Much of this increase reflects growth in installment sale financing consistent with improved motor vehicle sales. Growth in credit extension to the corporate sector, whilst more robust, has been on a downward trend for some time. Wage pressures are expected to continue to contribute to inflation persistence. Growth over 4 quarters in nominal remuneration per worker in the formal non-agricultural sector increased from 6.3% in the 2nd quarter of 2017 to 6.8% in the 3rd quarter. However, adjusting for labor productivity, growth in nominal unit labor costs declined from 6.1% to 5.5%. Average nominal remuneration increases are expected to remain above 6% over the forecast period. International oil prices have continued their upward trend to current levels of around $70 per barrel for Brent crude oil. These increases are due to supply restrictions by some producers as well as increased global demand. At this stage, it is unclear if these prices will settle at these levels or if the trend will be reversed by increased US shale output in response to higher prices. The oil price assumptions in the QPM have been adjusted upwards to average $62 per barrel in 2018 and 2019. Domestic petrol prices increased by 71 cents per litre in December, but were reduced by 34 cents per litre for 95 octane in January as a result of the stronger exchange rate. The current over-recovery on the petrol price points to a further price reduction in February should current trends persist. The MPC has taken note of the improved inflation outlook over the near term in particular. Inflation is expected to reach a low point below the midpoint, but is then expected to resume an upward trajectory and measure 5.5% in the final quarter of next year. This remains above the midpoint of the target range. The risks to the forecast are still assessed to be on the upside, though the degree of the upside has subsided. Two main risks featured prominently in the MPC discussions. The first is the prospect of a sovereign credit rating downgrade, which would result in 3 major ratings agencies rating South Africa's local currency debt as sub-investment grade. The impact on the rent and long bond yields could be significant, but the extent to which a universal downgrade is already priced in remains unclear. Furthermore, the assumption in the forecast for the starting point of the rand at 12 rands 90 against the US dollar is weaker than current levels. The response of government to the intensifying fiscal challenges in the upcoming budget will be key to avoiding this event. In addition, the pressures are now even more intense, with several state-owned enterprises facing financial risks. The challenge for government will be to find ways to finance the deficit in a growth-positive manner, and at the same time, convey a credible commitment to structural reforms that can raise the potential growth of the economy. This would also support business and consumer confidence. The second risk relates to international oil price developments. Although the assumptions have been raised over the forecast period, we still assess the risks to be moderately on the upside, and further upward adjustments may be required in the future. Demand pressures are benign, with core inflation pressures relatively contained. While household consumption expenditure is expected to be supported by positive wage growth, it remains constrained. The economic growth outlook is also more positive, but fragile. At this stage, the MPC assesses the risks to the growth forecast to be more or less balanced. The endogenous interest rate path generated by the quarterly projection model has changed slightly since the previous meeting. Whereas previously, 3 increases of 25 basis points by the end of 2019 were indicated, the third increase is now a marginal call. Furthermore, the timing of the first increase has been pushed out later in the period. The implied path remains a broad policy guide and could change in either direction by the next meeting in response to new developments and changing risks. In light of recent developments and the balance of risks, the MPC has decided that it would be appropriate to maintain the current monetary policy stance at this stage. Accordingly, the repurchase rate remains unchanged at 6.75% per annum. 5 members preferred an unchanged stance, while 1 member preferred a 25 basis point reduction. At this stage, let me pause and invite you to pose any questions that you might have. And as usual, please identify yourself and the media house that you represent. Sir Arabile. Oh, I thought I'm chairing, but Amukela.
Thank you. Amukela Bata from Bloomberg News. Governor, you said a cut was discussed or raised by at least 1 member of the MPC. Given that the outlook has, improved, could we see a cut sometime this year? We know that the model projected 3 rate increases this year, but is it possible for us to see a cut sometime this year if the current sentiment remains?
Governor Arabile Kumete from Bloomberg News. I'd like to start off by commending you, firstly, on the appointment of your 7th MPC member who will begin at the next meeting as well. I'm one that is quite happy with that one. But my question really is just, you've said that the inflation rate itself will go down to 4.4%, but then continues a trajectory that goes higher. Would it be fair then to say that it is because of the lack of a sustained low or midpoint inflation that you aren't cutting rates at this point?
What do you mean?
So
the
is
lack
it
of
because
sustained midpoint?
so that inflation does not remain at the midpoint for a sustained period of time?
Okay. Any other questions? Mfuneko.
Good day, Governor. I'm Mfuneko Doyana from Reuters News. 2 questions, please. First question is, are you concerned about the recent levels of volatility in the exchange rate? And if so, would you say that they're out of the ordinary? And how do they impact your assumptions overall? And a second question, the recent strength in the rand, does that give the bank an opportunity to perhaps increase its holdings of FX reserves? Thanks.
One more. Sir?
Governor John Bailey, ENCA. Can you elaborate on the reasons for the revision in the growth prospects for 2018 and 2019?
Okay. Amakhalang, the improved outlook and whether we can look forward to a cut later in the year. Yes, improved outlook, maybe can we look for a hike later this year, or could we look at rates staying the same later this year? Each one of those 3 decisions is still a decision. And at this meeting, the decision was to keep the monetary policy stance the same. At the next meeting, we will assess the data and the outlook and the trajectory, and based on that, we will decide whether we hold, we cut, or we hike. So we will take as every meeting as it comes, but as usual we would say that we remain data dependent. So if you want to know what is going to happen later in the year, I invite you to the press conference later in the year, and then you will know for sure what gets done at that meeting. Arabile,
well, that's the Reserve Bank Governor Lisicha Kanyako telling us that the repo rate remains unchanged at 6.75%. After a short break, we'll have an analysis from our experts. Do stay with us.
A lot of us rely on tech to survive, and Africa is already a mobile-first continent.
We build mobile technology that connects motorcycle taxis to commuters and businesses in real time.
My phone was the most important thing.
Africans are using technology to innovate. On Network, we have African technology and social media news. Even robots have heard about us.
Hello, watch Network on SABC.
For African technology and social media news, join Ms. Phumelele Zondi on Network every Sunday at 9 p.m.
When life takes a different turn.
If I didn't eat the steak, he was going to evict me.
Your will to persevere is ignited.
I'm not a professional speaker, but I'll try my best to give you a word of inspiration.
He was just trying to provide for his family.
If you can't accept it, change it. If you cannot change it, accept it.
And a new story begins.
Made a resolve to myself. I'm learning something new.
Upilong, every Friday at 5:30. Be part of the life-changing journey.
Welcome back to our special Monetary Policy Committee broadcast. Reserve Bank Governor telling the nation that the repo rate remains at 6.75%, which means the prime rate remains at 10.25%. Well, our guests today are George Glynis. He's the head of analytics at ETM Analytics, and Elise Kruger. She's an economist at NKC African Economics. And both of them were actually betting that we might get a rate cut and are presumably disappointed. George, let me start with you. What are your thoughts on the decision, and do you think they missed an opportunity?
I think they probably did. my frustration with this bank, and it's been for some time now, is that I believe there's something not quite right with either the manner in which they're analyzing their risks and the manner in which, in fact, they've been analyzing inflation, because throughout the course of 2017, they've been revising down their expectations for inflation quarter after quarter after quarter. So that's a first issue that I have. The second is that I'm not sure that they are analyzing, I don't believe that they're on top of the RAND calls. So I believe that there's a deficiency on that front because they certainly haven't anticipated some of the movements that have happened through the course of the past year. And then the third thing is there seems to be an inherent conservatism since Governor Kganyago has come in. Now, not that I have a problem with that in and of itself, but it seems like we almost looking for the problems whenever we sit down and decide on interest rates. And again, it goes back to the point that I was making a little bit earlier. I'm not sure that they are assessing the risks appropriately. It's almost like the risks are being catastrophized a little bit too much. And sometimes those risks are perhaps overblown and overplayed, and perhaps deeper analysis of those risks is required. I mean, one of them, and has been around for quite some time, has been the ratings downgrades and the impact that these ratings downgrades would have. And we've had several through the course of 2017, and yet the rand strengthened. The same thing happened in 2016. Now we're going into 2018, and we're using the expulsion from the WIGB as the potential catalyst for big outflows. But there are many mitigating reasons why that need not be the case. And so again, I would question the assessment of those risks, and I would strongly urge the central bank to perhaps rethink the process which they're adopting to assess those risks, because I don't believe that they're as great as they're making out.
You're getting ahead of my thought process. We'll come back to the ratings downgrades in just a moment. But Elise, just your very brief impressions of the decision.
Yes, I'm also a bit disappointed. I think they missed the opportunity. If you look at the headline CPI downgrade in forecast from 5.2 to 4.9, that's quite a big downward revision to headline CPI number. With figures, early in the year turning around 4.4%. If you're not cutting rates, if inflation is so benign and the rand has strengthened by 13% against the dollar, then it is in a way very conservative, especially if you also look at the real interest rate. And that's another angle, I think, which they haven't touched on. By not cutting rates today, our real interest rate will, in this first quarter of 2018, be in the order of 2.3%. That is the highest since 2010. With an economy, growing on average only about 0.6% in the past 2 years, it's definitely an economy now in dire need for stimulation. And still, our real interest rate is the highest in 7 years, and the Reserve Bank's sticky to adjust. So, from that point of view, I think they had an opportunity, to just help the confidence on a bit on and help spending a bit on. I mean, 25 basis points, and with a 13% appreciation in the rand exchange rate, there's quite a bit of fat. Even if we do see a bit of rand weakness for some reason, there's quite a bit of fat built in after this recent appreciation.
I agree with you for personal reasons. Without looking at the bigger picture, it would have been nice to have an interest rate cut. But what about the risks that he highlighted? He talked about the ratings downgrade, which you've alluded to, and obviously, things changing politically, the uncertainty about what's going to happen in the near term. Now, if things do turn negative, and they had cut interest rates today, it means that they would have to really hurtle up rates going forward if they were to take that chance today. Your thoughts?
Well, I'm not so sure that that's necessarily true. So let's just start with the political situation. If you had to look at the balance of risks as things stand right now and the events that have unfolded through the course of January, I'd say that the risks are asymmetrically skewed more in favor of positive outcomes through the course of the next 6 months than negative ones. The worst case scenario is that Zuma stays in power for a little bit longer. But I've yet to read an article that suggests with great conviction he's going to last his full term. So the risks on the political front have certainly abated, and abated considerably. Again, on the fiscal front, there was a significant reset that happened in the MTBPS, where realities and expectations, both by the market, economists, business people, everybody, was reset to a much lower level than was the case previously. So we had a great deal of realism that came through in the MTBPS. And in fact, when you look at things like he mentioned the cyclical upswing that's unfolding, the synchronized cyclical upswing, you may even find that the budget, when it gets announced later on in Feb, results in a little bit of relief rather than anything else. I think what I found interesting was that the biggest risk for me, if there was a risk, would probably be Eskom, and there was very little mentioned about Eskom other than the NERSA decision. I'm talking about Eskom's finances being as poor as they are. So it was a peculiar statement, and for me, interesting, but I don't necessarily have a problem with the unchanged, but in the context of what Elise was saying, a very weak growth environment, they probably might look back on this and think that they missed an opportunity to just trim.
Elise, the budget is around the corner, as George is saying, but of course there's this, estimated 12 to 15 billion rand hole that needs to be funded for the education policy that kicked in at the beginning of the year. Where is Malusi Gigaba going to find that money? And on top of that, we have a broader 40 billion rand hole in the public finances. And that is a key risk, and obviously the ratings agencies will be looking at that.
No, indeed. I think the way in which the budget will be approached is important, but also maybe in that regard, the higher economic growth expectation, which was also on the table today, slightly up for 2017 and also for 2018, will also help to spur, your tax revenue increase, growth and so on. So I think the slightly bigger growth will also help the fiscal problem. But yes, indeed, what they will actually come up with in a budget will be very important, from a ratings point of view and for the general perception of what the impact will be on the economy.
All right, well, we're going to...
If I can also just jump in there and just say that, if anything, when we look at the budget and what needs to be funded, there's serious question marks whether this is going to be something more along the lines of a growth restrictive budget that they put through. How they fund it is going to have to be a combination of some curtailment on the expenditure side and potentially a rise in the debt burden, in the tax burden on the private sector. The combination of that detracts from GDP growth. It's typically the kind of signal that central banks have in the past utilized to loosen the reins, not keep them tight.
George, we're going to pick up on your thought just after a short break. Let's go for that short break and we'll have more on this.
A warm welcome to one of your favorite weekly review analysis programs, Media Monitor. So let's look at the race itself.
It's just becoming a personality contest where people just want somebody to guard their own vested interest. And I feel that the country is at a point now where we need some sort of change.
It is ANC policy that they will have to implement. We fairly know the direction the ANC wants to take. As a leader, you have to implement. So what was it like on the ground in Kenya? Well, the country is divided. The country is very divided.
I think within the country, for me, the one person that I criticize severely, and I'm not very happy with his approach, is Raila Odinga, with him pulling out.
Stay tuned to Media Monitor and catch on analysts unpacking top stories every Sunday from 9 a.m.
Welcome back to our MPC broadcast. We continue our discussion with George Glynis and Elise Kruger. Thanks for joining us again. George, let's get back to the issue of the ratings agencies. People saying that if Moody's downgrade us, we'll come out of the World Global Bank Index, bond index, pardon me, and that will mean a lot of capital outflows. You don't seem to necessarily agree with this.
Yeah, I think it's far too simplistic an assumption that it's just the one equals the other. So let's give you a few mitigating factors just very quickly. many bonds of South African bonds get traded abroad. There are many holders of those bonds obviously sitting in the likes of London, New York and other financial centres. If an investment grade manager in one of those financial centres sells to another one who's also offshore, it doesn't come via South Africa. It need not be a rand impact at all. It simply gets traded abroad. It doesn't, it's rand neutral, in other words. If there are going to be sales out of South Africa, someone's got to buy it. And so the guys that are selling are not going to want to destroy their market by all jumping into the same exit funnel at the same time. So I believe that already there's probably been some preemptive exit from those portfolios, but equally, if there hasn't, I seriously doubt that it's all going to happen through the course of a day or two. Thirdly, a lot of the domestic fund managers are seeing local interest rates, bond yields, at very positive real interest rates. And for inflation plus mandates, these are very attractive. So there's going to be natural domestic demand from the local fund managers. Then there's issues of big fund managers abroad that within their own bouquet of portfolios can simply adjust and shift from one to the other. There's a softening of mandates for funds abroad that have got defined benefits and that are underwater that need to try and attract yield. They've been allowed to invest into riskier markets as well. There are a number of factors that combined, when you have a look at all of this, on top of the fact that it is entirely unclear that everybody heads for the exit door at the same time, that I don't believe that it's going to have anywhere near the impact that's being feared at the moment. Perhaps a few cents here and there, 20, 30 cents, but in the broader scheme of things, that definitely hardly changes an inflation forecast.
Elise, things are looking good though. I mean, the governor is saying that average wages are going to increase above 6% for the consumer. That's a good thing. He's talking about lower inflation, generally speaking, an improved rand exchange rate, although the oil price remains, fairly high, but he's not sure as to whether that's going to be sustainably so. The picture does look a bit better. In the fourth quarter of last year, there was an increase of about 20% in the purchase of durable products. Doesn't look too bad.
No, indeed. No, we have revised our GDP growth forecast upwards in the recent month for the reasons which you just alluded to, and we have incorporated 25 basis point cuts in interest rates, in that forecast, but also the lower inflation and the impact that will have on the purchasing power of households. So we think a real GDP growth rate in the order of 1.7% for 2018 is not unrealistic. That is even 0.3 higher than what the SABC has indicated today. So yes, indeed, it does look quite positive. And if the risks, as we discuss here, does not play out as negative as the bank foresee, I think come March they might be slightly behind the curve in terms of stimulating the economy and bringing real rates a bit closer to a better long-term level. So I think by that time we could definitely see a cut if there hasn't been a significant negative play out, which, like we say, could perhaps be over anticipated at this stage.
And just simply explain to the viewers that real interest rates are at the highest they've been in a while. Just explain what that means.
Yeah, that's indeed a measure to show how restrictive monetary policy indeed is. In the world, if you look at the current scenario post the global financial crisis, central banks cut rates to the extent where the real interest rate is actually negative. Stimulating the economy, make it easier to borrow, lower and easier, lower cost, to try and get the economy going. So like I've mentioned, we are at such low levels for our economic growth rate. So does it make sense to have a restrictive real interest rate environment? And the Reserve Bank has actually informally, noted that they would be comfortable with a 1.5%, long-term real interest rate. So that shows you that anything above 2% would definitely be considered to be quite restrictive on the economy. And that doesn't gel for me, if you look at the actual sort of dismal economic growth outlook that we still have on the table.
Now, when you look at the various sectors, agriculture has been an important contributor to GDP. What's your prognosis in terms of the sectors that are going to move things this year?
I mean, agriculture always tends to be a big swing factor, and we're going to see how that unfolds through the course of this year, because we've still got bad drought conditions that are unfolding in the Western Cape, and The full effects of that, I think, still have to be felt. So we're going to see how that unfolds. Cyclically, you'll probably find banking stocks doing a little bit better now because of just the general upswing and improved confidence, etc., etc. But, you know, it's such insipid growth that, you know, when I look across the sectors, it's very difficult to pick clear outperformers and clear underperformers. I just don't believe any of the sectors are performing particularly well. It's more a case of every now and then in agriculture you might get this, you know, cyclical recovery, upswing to some degree, but yeah, the real fundamental stuff, I mean, we should be talking about growth north of 4%. You know, then we'd be able to talk about the real strength and cycles of the underlying sectors. As it stands right now, I mean, South Africa is just bungling along. We're bungling along, and growth remains, as I said, fairly insipid. I don't see it improving dramatically, but it'll be better than last year, thankfully. But again, you know, let's wait and see how things unfold. I suspect, you know, just following on from what Elise was saying with the real rates, in the models that we look at to assess resilience of the rand, I can tell you that plays a significant role in adding to the resilience of the rand, which in and of itself is not a bad thing. I would welcome that. But again, I question whether they hold the same bullish view on rand as we do, that we've had for quite some time and that we continue to hold going forward, at least for the next 6 to 8 and perhaps 9 months. Now, if we're sitting talking about a rand closer to 11.50 or below to the dollar through the course of the next couple of quarters, I tell you their inflation forecasts are going to be revised down yet again. And I'm talking now probably for about close on the 7th or 8th quarter in succession. So these inflation moderations and inflation beating expectations to the downside month after month after month is a trend that we think continues. It continues through the course of the next few months, partly because we've got a very tight monetary growth environment, partly because of things like positive real interest rates, fairly weak demand levels. I wouldn't take the latest retail sales. I'd take them with a bit of a pinch of salt at this point. Again, I think all we've done now is ensured that March we will be cutting. So perhaps we were a little bit ahead of the curve this time around in terms of the Reserve Bank's curve. But I still suspect that we've got cuts before we have hikes.
Well, let's hope you're right. He talked about 2 interest rate hikes and the third one being marginal. What do you think he meant by that?
Well, I think, you know, the new quarterly prediction model, you know, it's still new, and we probably need to engage a lot more with the SABC people to maybe understand exactly what it means. But as I understood it, you know, they basically work with differential to long-term equilibrium levels, and for the inflation rate, they use the 4.5% midpoint of the target range. Now, so for as long as inflation, on average, is expected to be above that, the model will signal, in combination now with some of the other variables, that rates will have to be increased. Although in my book, you know, 4.9% headline CPI, while economic growth is so low, is for me an environment to cut rates. Whereas, you know, from the model's point of view, they would like to be closer to the neutral level of 4.5% before rate cuts will be signaled by the model. Now, the model is only a tool or an additional sort of measure to look at in the deliberations. But in a sense, I think that does influence the market. You know, and the +3 sort of 25 basis point hikes flagged at the previous meeting had everybody a bit up in arms, you know, sort of not seeing that maybe the scope has opened up for the cut. So yes, I think overall, to me, that's sort of missing a bit of the window that we see by focusing on that.
All right. Well, we've run out of time. So much more to talk about. Thank you very much, both of you, for your time. That was George Glynis. He's head of analytics at ETM Analytics, and Elise Kruger, economist at NKC African Economics. Pardon me. Thank you very much for having joined us. It's the end of our show.